thank you all, and thank you very much, Philip, for your talk earlier. A very thought-provoking, interesting thought, and a good reminder about, whilst there are uncertainties ahead, there's certainly a lot of cause for optimism. We have got a great opportunity to ask some questions. So Philip has kindly agreed to come back up and take a bit of Q&A. So I'll be asking everybody in the audience if they have any, and please put up your hand and we'll bring around a microphone. We've also got some coming through on live stream, Philip, so I'm told they're being censored, so I hope they are. I'm just going to kick things off with a nice easy overarm one to get you in the mood and ask you the question that I'm sure you've been asked 50 times over the past week, but the impact of globally, we're looking at Brexit, we're looking at Trump. In your position as the Governor of the Reserve Bank, how do you approach those great uncertainties, and how do you make sure we're positioned to deal with what's coming, whatever that may be?
Well, as you point out, there are a lot of uncertainties there, but as the Reserve Bank, what we can do is, I think, draw attention to the issues and try to do that partly tonight. And so one of the things that society can do to prepare for uncertainties is kind of to make sure that we build up these buffers, and that gives us options no matter what happens in the world. And it's kind of interesting since the President Trump was elected. They've seen bond yields in the US rise 40 basis points. The US dollar's risen a little bit, and the US equity market's kind of up a little bit. But one of the things he has said is he'd increase spending on infrastructure, and he would attempt to deregulate the system. And I've been attending the G20 meetings for the last 3 or 4 years, and a constant theme of the G20 has been the need to increase spending on infrastructure and to do supply-side reforms. So at least to date, the markets have read into some of the things that he has said that he's going to do those things. So if that happens, that will be good for the US economy. I think what could be very, very bad, and something that we need to watch very carefully, but it's not something the central bank can do anything about, is a retreat from openness. Because if that were to happen, that would be very bad for the global economy. It would be very bad for us. Australia, as you know, for the more than 200 years, has benefited from openness. We've kind of sold stuff to the world, gold and then wool and wheat and now minerals, and that's really the basis of much of the wealth that we currently enjoy. So if we saw a retreat from openness, that would be costly for the US, and it would be very costly for us. It's not something the central bank can do anything about, but it's of the things that I worry about. That's probably right at the top of the list. And you can see in country after country, there's a political movement away from support for open trade in goods and services and open movement of capital. And I think that's dangerous for the world, and it's particularly dangerous for us. So we, like everyone else, is watching and waiting to see what transpires in the US, because it's a bit hard to tell.
There was a question over.
Thank you, Dr. Lowe. It's Ben Potter from the Australian Financial Review. Little bit of a follow-up, really. I was going to observe that central banks have been calling on governments to spend more freely on sound infrastructure projects for a long time, and you mentioned that. What they're also concerned about is borrowing to fund ongoing recurrent expenditure, or in the case of Mr. Trump, quite possibly large tax cuts. And I wonder, is that the downside of the program he's outlined, that you worry about, that it could rattle bond markets and send yields even further up and bonds down, and generally create more uncertainty?
Well, yields have gone up, as I said, 40 basis points in the US. And that's really been transmitted right around the world. And part of it's due to people expecting higher inflation than they previously were. And if that's what's happened, to the extent that that's sustained, that's a good thing. Because there was a concern in the international policy community that lower inflation expectations were getting entrenched. So the movements in the US have reduced that risk a little bit, so that's good. And to the extent that stronger growth pushes up interest rates and pushes up bond yields, that's not bad for the global economy. So a bit more debt in the US I don't see as particularly problematic. As I said before, what could be particularly problematic is a retreat from openness.
While we're on global Brexit, did you want to make a comment on how on what you see the impact of Brexit may be?
Well, again, that's another thing that's very hard to predict. I basically see the decision that the UK citizens made was a decision to make themselves poorer but have more control. That's a perfectly legitimate choice for the population to make. What implications that has for the global economy, I'm not sure. I think it really depends upon what happens in the rest of Europe, because if the UK decides to be a little bit poorer, well, that's not good for them, but they get the control they want. It needn't be damaging to the rest of us. What could be damaging for us if that was kind of that was a pull on the thread of the European fabric and the whole European project came unstuck. My sense is, talking to my colleagues in Europe, that that's quite unlikely to occur, and at least in some quarters there's been doubling down to make sure that that fabric doesn't get, that thread doesn't get pulled too much and destroy the fabric. So again, I think it's manageable.
Poorer and more control. I think I saw that slogan in the UK debates. Thank you. Sorry.
Yes, Bob Edgar, Governor. You did mention, I think at some part in your speech, about the quantitative easing. I think one of the things that concerns a lot of us in people that worry about the financial system is this is an unparalleled expansion in liquidity by central banks. And in its stability sense, it must be based on the concept of it will withdraw in some sort of measured fashion. This injection, which increasingly seems to have run out of any oomph in terms of its intended impact. Not particularly an Australian question, but a global impact for Australia. I mean, how seriously can we take the fact that what can be sort of expanded can also be contracted by central banks in order and way to avoid the inevitable consequences historically of this massive expansion of underlying liquidity?
Yeah, it's a very good question. I just kind of take one step back. The central banks that have essentially created electronic money to buy assets, that's what we're talking about. So that's supposed to affect the economy in two ways. One, it pushes up the price of the assets that you've purchased. So it might push up the government securities, and so the yield comes down, or it might, seeing in the UK now them buying corporate bonds, and in Japan, the Bank of Japan is buying ETFs. So presumably that's supposed to push up the stock market. So that's part of the mechanism, and the other is that the money creation leads to banks having very large balances at the central bank, earning in most cases nothing, or in some cases zero. And that's supposed to be stimulatory, because the banks are supposed to say, well, I can find an asset somewhere in the global economy that's more attractive on a risk-adjusted basis than leaving the money at the central bank earning zero. And as banks find things to do with all this extra money, that's supposed to stimulate the economy. And my observation is that really hasn't worked, because the banks haven't found better things to do with their money than leave it at the central bank. And the lower interest rates on bonds haven't really stimulated very much demand in the economy. So it's been relatively ineffective. Not completely ineffective, but relatively ineffective. And your question is, what happens when all this ends, and if the central bank starts selling the assets and forcing the prices down, or all this extra liquidity sitting in central banks starts to be removed? I'm not particularly concerned about that, because the central banks can lock up that liquidity that's sitting on their balance sheets. They can require, through various ways, banks to actually hold higher balances at the central bank. So there's not, while there might be a lot of liquidity there, it needn't be free liquidity. It could be kind of tied up through kind of various requirements. So, and I don't think in the unwind process, the central banks, I don't think, are going to start selling en masse the assets that they've purchased. And they would only do that if the economy could sustain those asset sales. So I think the unwind is not, it's not really a problem. I don't see that kind of as problematic. The thing that's taken up most attention in the discussions I've been involved in is kind of the effectiveness of these two channels I talked about, why it is that the lower interest rates aren't stimulating spending around the world, and why financial institutions, with in some cases billions and billions of dollars sitting at the central bank earning zero, can't find something better to do with it.
Dr. Lowe, Michael Heath from Bloomberg. You mentioned in your last speech and again tonight that one of your greatest fears is the rise of protectionism. Presumably we've gone further into that now. What are the implications for Australia if we wind up with 45% tariffs being slapped on Chinese exports to the US and some sort of trade war begins to unfold?
Well, I don't want to speculate all the ramifications of that. My short answer is it would not be good for us. It would not be good for the world. Because one could imagine if those type of tariffs got put on Chinese goods by the United States, then there would be some response by China as well, which would not be good for the US economy or the Chinese economy, and by extension it wouldn't be good for us. So I hope that wiser heads will prevail here. We, as an open trading country that's really built our wealth on international trade and open capital markets, for 200 years, Australia has been an importer of capital. We've almost every year for the last 200 years, we've invested more in this country than we've saved, and we've built up our capital stock. The only way that we've been able to do that is to have capital flow to Australia. We've drawn on savings elsewhere in the world. So we've built this fabulous country partly on domestic savings, but also partly on foreign savings, and being able to sell kind of the natural resources and the kind of the man-made things we can make here with our talents. We've made our wealth by selling that to the world, and by borrowing money from the rest of the world to build the assets that have allowed us to do that. So anything that threatens that is a huge threat to our economy. So I hope that in the end wiser heads will prevail here.
The recent minutes reflect that there was a discussion about the China slowdown. I wonder if you wanted to share your views on the China economy more broadly.
Well, recently the Chinese data have been a bit better than earlier. The two things have happened. One is the central government and the provincial governments are spending more on infrastructure, and that's made a difference. And the housing markets have strengthened as well. So there's a bit more housing construction, and the housing prices are rising. So that's good for the short run. It's been good for the iron ore price. It's been good for the steel price. Some cutbacks in supply of iron ore production in China have also helped. So that's good. The issue is, at what cost does the pickup in short-term growth come with? Because the fundamental issue in China, the fundamental risk, is the very high levels of debt that are being run up. And really, over the course of this year, they have not addressed that. In fact, the debt problems have got better, have got worse rather than better. The benefit we've got is stronger short-term growth, but at what cost? And no one really knows how that's ultimately going to play out. But as things have transpired this year, it's been good for us. And as I said in my remarks, the terms of trade are up. Really, it's the first time in 4 years we've seen them, and that's going to be good for us in the short run. And positively, what we've seen in China is a significant cutback in excess capacity in coal production and iron ore production. Because this was when the iron ore price fell so far and the coal price fell so far, one of the reasons that occurred is that the Chinese continued to supply a lot into the market, even loss-making production. And many people, including us, were surprised that the cutback in production in China didn't occur more quickly, but it is now occurring. And I think that's a positive sign because it pushes up commodity prices, but it also suggests the Chinese are addressing overcapacity in some industries, which in the long run must be good.
We had a question from this side.
Campbell Rose from VicTrack. Philip, thank you for an excellent presentation. A different question from a different angle. What's the Reserve Bank's view on central banks, and in particular the Australian Reserve Bank, on the advent of blockchain technology?
what's the view? We're watching. I think my view on this is perhaps too simplistic, but the distributed ledger is really another form of database technology, and the new database technology may transform the way that financial services are provided, or it may not. I don't know. You talk to some of the proponents of innovations, and that they have kind of fantastic stories how it could be transformational. I'd observe that, at least to date, there have not been really strong business cases put forward and implemented. So, it's possible. We're watching. Another area that the central banks are closely following is the possibility of some type of blockchain technology leading to a digital currency to replace banknotes. So that's something that we're watching. Australia isn't at the forefront of that. Some other countries have spent more effort thinking about that, but again, it's something that we're watching. So it's perhaps transformational, but maybe not.
Dr. Lowe, I'd be interested in your views on how you think the emerging market economies are placed to deal with the volatility that we're about to, I guess, experience over the next period.
Well, since it depends which emerging market countries we've talked about. I mean, Mexico, their currency's fallen by 10% and their stock market's down quite a long way. And that's really reverberated right through Central and South America. We've even seen, so that's problematic. And we've seen in the last few days some of the Asian currencies fall by a reasonable amount and their equity markets be quite weak. And I think what that's reflecting is the fears about a retreat from open free trade. How well are they prepared to deal with it? Reasonably well. It's not like the possibility of higher interest rates in the US and a retreat from free trade have come completely out of the blue. So these countries have had quite a lot of time to prepare for it. I remember, back a year, there was a lot of concern in emerging market countries about what would happen when the US first raised interest rates. They raised interest rates and the emerging markets kind of dealt with that reasonably well because they'd been able to prepare for it, and you talk to my colleagues in a number of particularly the Southeast Asian central banks, they've spent a lot of time trying to prepare their systems. So, but if we do see a generalised retreat from free trade, it will be difficult for everybody. I don't think we can escape that.
Thank you. Ross Jackson from Maddox Lawyers. Dr. Lowe, thank you for your presentation tonight. You spoke of our better than expected performance in adjusting to the end of the mining boom. Here in Victoria, of course, we've seen the cessation of manufacturing at Ford. We have the cessation of manufacturing from Holden and Toyota next year, and obviously the closure of the Hazelwood Power Station. How effectively do you think our buffers are expected to perform in relation to those quite significant adjustments within the particularly Victorian and South Australian economies?
Yeah. Well, they're obviously very significant events and very difficult for the communities involved. But I would make the observation that despite that's all happening, the Victorian economy is doing reasonably well. Now, the population growth of Victoria is 2%. People are moving to this state, to this city. Victoria's, I think, got the fastest population growth in the country. It's doing well in quite a number of areas of the economy, including in education. So I'm confident that the system has enough adaptability that we can deal with structural changes like the one that you have talked about. Now, our economy has gone through huge adjustment in the past decade. We accommodated the biggest resources boom in a century. Mining investment went from 2% of GDP to 8% of GDP. Haven't seen anything really like that before. We didn't blow ourselves up. In the past when things like that had happened, we'd had a wages blowout, prices went up too quickly, lending got out of control. Didn't happen. And then on the downside, we've had a huge decline in commodity prices. The decline in mining investment is 80% over. And we've adjusted to that. Right through that period, we've grown kind of average 3%, and the unemployment rate's been 5 point something most of the time. So for whatever reason, and I think it's really hard to be too specific, but for whatever reason, our system has quite a degree of flexibility, and I'm confident Victoria will see that as well. As difficult it is for the communities concerned, but we have a lot of resilience.
You can't be specific, you say, Philip, but you must have some sense of what it is that allows us to be resilient in the face of those shocks.
I think monetary policy's helped. The fact that we've had the capability to lower interest rates a long way, I think that's played a decent, a fair role. The flexibility of the exchange rate's very important. When the exchange rate was $1.05 or $1.08 against the US dollar, I'd have people come to see me all the time complaining, and I can understand why they were. And they said, if only it could get below $1, we'd be okay. And then it was kind of 95. If only we could get below 90 cents, it would be okay. And now we're at kind of 75 cents. And the firms that have survived that very high exchange rate, found efficiencies and are now, in many cases, competitive. And some of those firms here are right here in Victoria and doing kind of specialised, value-added manufacturing. And it's not employing as many people as cars, but it's happening, and the exchange rate's a factor. And the other one is the flexibility in the labour market. And there are certainly issues that need addressing in the labour market, but aggregate wage flexibility has been a real asset to us. It wasn't that long ago where the standard wage increase in Australia was 4%. If you got less than 4%, you felt hard done by. And now the default wage increase is 2%. And in some businesses, workers have agreed to even smaller increases than that. And that ability of kind of a wage cost to adjust to the changing labour market's been incredibly important in keeping people in jobs. So the flexibility of the labour market, the exchange rate and interest rates, and the basic kind of dynamic nature of our economy, and in Victoria, very strong population growth have all helped. The population growth is something that is underrated. Just think in Australia, in 5 years' time, there'll probably be 8% more people, 8 or 9% more people living in our country. So the pie is getting bigger all the time. Compare that to Japan, where in 5 years' time there'll be 3% less people. So it's one of our kind of fundamental advantages that the pie here is growing because of population growth, and that creates a dynamism in the economy that the economies of North Asia and Europe do not have. It's important.
It's probably something we should talk more about. Is there any other questions from the floor? I can't see. Yes, thank you.
We need sun visors up here.
Marianne D. Gialinardo, Director of Corporate Services at Maroondah City Council. I'm doing a budget at the moment. Have you got your crystal ball? What is CPI doing in the next 12 months? It is so hard to pick, and I've got all the banks together and I've divided it and multiplied it. What's your go for CPI next year?
Well, I don't have a crystal ball here, but it's very similar to what it's been the last year, and I hope it's a little higher. But if I can kind of make a serious point here. Now, underlying inflation in Australia is 1.5%. So our medium-term target's 2.5%. So we're a bit below where we would like to be. But because we have a flexible medium-term target, that's okay. And some of my colleagues in other central banks would say, oh, I'm away from the target, so I've got to keep kind of cranking the monetary stimulus machine to get inflation back as quickly to 2.5% as we possibly can. That has not been our perspective, that as long as we think that inflation will gradually get back to 2.5%, it has not been worth the risk of just encouraging get more borrowing through lower interest rates to get inflation back even more quickly. So I've kind of digressed here really, but the point is we hope inflation will be a bit higher, and I think there are reasonable prospects that inflation will return to 2.5% in this country, and really I want to do my best to convince everyone here that that's what inflation's going to average, 2.5%. You shouldn't be worried that inflation's going to get stuck at 1.5% in this country. I think that's very unlikely. My job is to give to the community an average rate of inflation of 2 point something, and I hope over my 7 years I'll be able to do that. But you won't have to wait 7 years for it.
Dr. Lowe, I've just got one more question.
Sorry, where are we?
So Janet Yellen has talked about the benefits, I guess, of running a high-pressure economy. What are your views on doing that to help get back to our inflation target?
Well, I don't really want to comment on kind of the argument for doing that in the US. I can probably explain to you kind of what I see as the analytical argument for doing that, and it really would rest on what's going on in the labour market, because the thing that has surprised many of my peers around the world is that even though the unemployment rates are quite low, wage increases are even lower than you would think. So we've got quite low unemployment rates, but wages aren't really responding to that, and you're not seeing wage growth pick up. So if you take the average unemployment rate in the US, Germany, Japan and the United Kingdom, it's the lowest in 30 years. You wouldn't, reading the press, you wouldn't kind of understand that. But the wage increases are very low, and we run models of what wage increases should be given the rate of unemployment, and even in Australia the actual outcomes are less than the models, and in many other countries they feel that as well, or they see that as well. And I think one of the reasons that that's occurring is that workers in Western countries feel like they've got very little pricing power. They worry about globalisation, they worry about technology, they feel uncertain after the financial crisis, so they don't really want to put their hand up and say, look, can I have a bigger wage rise? There are exceptions to that, but that's kind of as a stylised characterisation. So the argument for a high-pressure economy would be to re-energise people to feel like they've got market power and get inflation to return more quickly to the target. So that would be an analytical argument for running a high-pressure economy to kind of re-energise the pricing power that both workers and businesses feel they don't have. And many businesses that I talk to say, well, look, we can't really put our prices up because if we do, there's a competitor or we'll lose market share to someone in China or India or somewhere else around the world. So people feel like they've got very little pricing power, which makes for a depressed inflation environment, and if you ran a high-pressure economy, you would re-energise the pricing power. That would be the argument. There would be risks involved in that, particularly on encouraging kind of borrowing and credit expansion, and so you've got to trade off the benefits you get from a quicker return from inflation to target against the financial risk that you would run from doing that. Yeah.
Thank you for your...
Yes, fine. One more question.
Okay.
Governor Lowe, thank you very much for your address to the dinner this evening. I guess my question follows from Dr. Bob Edgar's question around global liquidity. Andrew Tate from Westpac. You've covered the banking system, the fiscal arena and household balance sheets. You've mentioned buffers and options under each and various scenarios. I'm wondering what your observations are or what you're looking for as both the RBA governor and as the RBA in terms of what external shocks could come into our system that might simultaneously affect all three areas as that 1 in 25 year event.
Yeah, well, I've got to be careful here because I don't want to predict bad news, and but the things that we worry about are kind of there are three kind of at the global level. There's one about trade, which I've spoken about that. The second would be something going badly wrong in China, and if something were to go badly wrong in there, which I think is unlikely, it's mainly around the problems of excess debt. and that the high levels of debt in the corporate and state-owned enterprises ultimately cause a financial meltdown somewhere in China, and that causes problems for the Chinese economy and ultimately us. So that would be the second thing. And the third one would be, coming back to an issue we talked about before, is the European fabric starting to tear apart, and the whole future of the euro coming under a cloud. That would be a much bigger deal than Britain kind of deciding to leave. So I think each of those things is quite unlikely. As I said, on trade, I think wiser heads will prevail. China's got a demonstrated ability to manage its problems, and in Europe the policymakers are doubling down on whether they can convince the electorate to support the European project. So I think in each of those cases that if something were to happen, it could be quite bad for us, but the probability is still low. And I think a final observation I'd make is that it's very hard to predict these, where the shocks are going to come from. At the moment, I can list these things. I could probably list a few more for you, but I don't want to worry you. But the reality is it probably won't be any of those. There'll be something else that happens somewhere in the world. And this is why kind of tonight I wanted to draw attention to the kind of the importance of making sure that whatever the shock is, we've got these kind of protective buffers that really have served us well for 25 years, and in a number of areas they're not as strong as they once were, and we need to strengthen them again.
Thank you. I'm now getting the wind up, but thank you for your questions and thank you for Philip for your candid and thoughtful answers. I'd now like to invite Debbie Blakey up, who's the Chief Executive Officer for HESTA, to move a vote of thanks. Debbie?
Thank you.